Time now for Hot Picks. Today we're focused on the U.S. insurance segment. Joining me is Cathy Seifert, Vice President of Research at CFRA. Cathy, thanks a lot for joining us. This will be a good conversation. First of all, what do you look for in an insurance stock? And secondly, what is the current macro environment like for this sector?
Sure. I'll answer the second question first because I think it's important to frame this discussion against sort of what drove the stocks last year versus catalysts for this year. And so last year, and I'm going to focus the discussion today on the property casualty insurance space because I think within the broader insurance space, there are still catalysts there and valuations still remain attractive. So last year, what we saw was pricing power that the insurance industry retained. And that pricing power served as a catalyst and a tailwind for most property casualty insurers. And the group outperformed the broader market last year. This year, I think it's a little bit of a different story. And I think outperformance this year is going to be driven by company-specific catalysts and dynamics. And so against that backdrop, what I look for in this environment, I think it makes sense to focus on perhaps some names that are a little more economically defensive and whose shares have relatively low beta so that they're not overly correlated to the broader equity markets. I mean, I think what's going on in the U.S., what's going on in Washington with deportations and tariffs injects a degree of uncertainty into the broader macro picture in the U.S., into the trade picture, and also into the insurance underwriting picture. I'll stop here and we can focus on some names if you like.
Yeah, let's do that. Arch Capital is one. It's based, I believe, in Bermuda. It's a global provider of life, health, property insurance. It operates in Canada, in Europe, Asia, and in the United States. Why do you like Arch Capital? Ticker symbol ACGL.
Arch was a high flyer last year that pulled back a little bit when they had some managerial changes. Arch is more exposed than the other two names to sort of a broader economy, but Arch happens to be a very good underwriter, a very good risk assessor. It's poised to grow above the rate of most of its peers, yet it trades at a discount to some of the peers. And I think the stock still has a number of attractive catalysts, and following a pullback, I think the shares offer a compelling value right now.
Okay, let's go to the second pick, Allstate, certainly a familiar name in this business. So we'll put up the graph on Allstate and you can tell us why you like this one as well. You have a strong buy on the stock we just talked about, Arch, and you've got a strong buy on Allstate as well.
So to my earlier comments about economic uncertainty, there is an argument to be made for focusing on some of the personal lines insurers, those companies that provide auto and homeowners coverage, largely because they tend to be a little more economically defensive. Coverage is mandated by law. It's not necessarily a discretionary purchase. And in the case of Allstate, the company has been refining its underwriting practices, doing a lot of risk mitigation, streamlining its operations. They continue to have pricing power, and I think it's an attractive defensive name. Now, I think that, and the other thing is the majority of Allstate's business is in auto insurance. Auto insurers still retain pricing power, and while the tariffs could inject a degree of inflation into auto claim costs, I think the offset here, again, from an investment perspective, not necessarily to the benefit of the consumer, but I think auto insurers still retain pricing power. Regulators are cognizant of the pressures facing this industry, and they have been a little more amenable in passing along rate increases. So I think the combination of a low beta, an attractive valuation, a defensive mix of business, and continued pricing power all combine to make Allstate an attractive investment.
Okay, number 3 on the list is Progressive Group, another well-known name in the sector.
It's a well-known name, and Progressive is sort of the high flyer in the group. Last year, Progressive's performance beat that of most of the Mag 7 stocks in the technology space. Now, I don't think that performance is necessarily going to be replicated this year, but I think any pullback in Progressive offers an attractive entree into a stock that has best-in-class risk management, underwriting metrics, and as a result grows about double that of the industry. It's kind of a flywheel in motion, and anytime the flywheel loses a little momentum, I think it makes sense for investors to take a look at the stock.
Cathy, thank you so much for this conversation. Cathy Seifert is Vice President of Research at CFRA, and those were her picks in the U.S. insurance sector, mainly property and casualty insurance stocks.